Good day, everyone. Today, we will talk about one of the oldest forms of modern insurance, marine insurance. Marine insurance has a history of all to itself. At the end of the 17th century, London became one of the most important places for trade and exchange. In the late 1680s, a man called Edward Lloyd opened a coffee shop on Tower Street in London, where the shipowners, sailors, merchants and captains would come every day. Eventually, this small coffee shop became the meeting place of shipping partners, from the merchant looking to insure the shipment of their goods to the carriers seeking to insure their vessels, and one, of course, those who wanted to underwrite all this business. Marine insurance was born. The small coffee shop continued to grow and became one of the most famous insurance marketplaces in the world, the Lloyd's of London. So what does marine insurance look like today in a globalized and modern world? Marine insurance continues to grow and now covers even more categories of risk, such as energy, yacht, or builders risk, for example. On the reinsurance side, some markets make the distinction between two categories of insurance only, marine and non-marine risks. This goes to show how important marine insurance has become. There are plenty of subcategories in marine insurance. So in this video, we will focus on the three main categories that are cargo, hull and machinery, and P&I. First, cargo insurance. What is cargo insurance? Well, as you know, when a shipper entrusts its goods to a carrier, the carrier becomes responsible if the goods are subject to losses and/or damage. The carrier is covered by a minimal legal insurance policy known as carrier's liability, but the coverage amount that is granted is usually quite small and does not offer a comprehensive protection to the goods. And this is where cargo insurance comes onto the scene. Cargo insurance protects the goods from losses and damages when transported by sea or air, and also during inland transportation by rail or road, until they reach their final destination. Cargo insurance even covers the goods during the loading and unloading phases. So, it's a type of all-risk property insurance for goods in transit from the time they leave the shipper's warehouse until they reach the final destination. Because trade is international, cargo insurance conditions were standardized into the Institute Cargo Clause, ICC, that is used worldwide. These clauses specify what items in the cargo are covered as well as the applicable conditions. There are three basic sets of conditions, the ICC-A, B, or C. To simplify, ICC-A provides the widest coverage, offering protection against all risk for all types of items. ICC-B slightly reduces the scope of cover, and as you have guessed, the C version of the ICC is the most restrictive one on a named period basis. Now that the goods are protected, what about the vessels itself? Well, the vessel is covered by hull and machinery insurance. Hull and machinery insurance covers physical damages to the vessel itself when at sea or other perils that could occur during transportation, such as piracy, fire, or explosion. The shipowner also has the option of writing additional covers such as loss of hire, protection against a daily loss due to physical damage to the vessels, or war risk protection. One of the most important options is a running down clause that provides additional legal liability protection for damages in the event of collision with another vessel when the insurance is at cause. But it is very important to understand that this running down clause does not cover any legal liability arising from bodily injury, death, or damages to fixed installation, such as harbor. If the ship owner wants protection for this kind of liability, then it needs to take out protection and indemnity insurance, which is the third category of marine insurance that we will discuss in this video. Protection and indemnity, known as P&I, supplements the running down clause found in hull and machinery policies. It covers a policyholder's liability when he is at fault and causes material, immaterial, and bodily injury damages to a third party, whether a fixed or floating object is involved. In short, it provides third-party liability protection to the carrier. One of the special features of P&I is that it is not provided by traditional insurance companies, but by a P&I club. These clubs are mutual insurance associations run by marine professionals, shipowners, operators, or charterers. The members' risks are pooled in accordance with the pooling agreement rules of the clubs. The club's purpose is not to make profit, so the amount of premium, or shall I say fees, are rebalanced each year in accordance with the result of the pool. When the pool is in the red, members will have to pay additional fees. On the other end, if the results of the pool are a profit, the fees will be reduced the following year. The historical reason for having liability carried by P&I club instead of traditional marine insurer are that marine insurers were providing cover on miserable and limited risk only. The amount of protection provided by traditional insurers was not enough to cover the development of maritime trade exchange in the 19th century. As the amount and the number of losses increased, P&I clubs were created to fill this gap and protect the ship owners. Nowadays, P&I clubs provide 90% of the liability protection provided to the world's marine industry and are grouped under the international group of P&I clubs based in London, next to the Lloyd's of London building, close to where it all began with our old friends Edward Lloyd, and now the circle is complete. I hope you enjoyed this overview of the marine insurance world and see you soon for the last video of the season hosted by Clemens. Credit and bonds!